Welcome back, you legends. I'm Dr. Khan. Let's get right into this video. This is going to be a short and sweet quick update video because it's 1:15 a.m. where I'm at and I need to catch some C's. But you all know I upload these videos because I love all of you legends. So let's get right into it. The S&P 500 today is down 0.65%. The Nasdaq is down 1.1% and the Dow is actually slightly up on the day. Let's take a look at the different sectors. Leading is real estate, defensives, and healthcare. So a bit of a risk-off day today. Lagging tech, communication services, and financials, as well as cyclicals. Again, a very typical risk-off day. Let's take a look at the stock market map. And again, defensives, healthcare, leading the pack, as well as real estate, and big tech taking a big hit, as well as financials. Remember, everybody, at the end of this week on Friday, we're going to have a lot of banks reporting. And so we're seeing big money reducing risk running into those earnings reports just in case they are horrific. Now, let's jump into the daily chart for the S&P 500, everybody. And just look at that, guys. We have now 3 consecutive days with lower lows, but we haven't yet closed below the September 30th low. We're getting extremely close. The triple Qs, the Nasdaq has already taken out the September low. The S&P hasn't, largely being lifted up by stocks like energy, defensives, real estate, and healthcare. And we're now beginning to see something very interesting that prompted me to take a trade today, a very short and sweet trade with a 40% profit. This is the trading group, everybody. A lot of people have messaged me asking about the trading group. This is what it looks like. We have 2 sections, the Money Time Machine section and the members section. The Money Time Machine section is for me to share my daily technical analysis, my daily trades, every single entry and exit I post in real time, as well as my trade ideas and my investment ideas and my interpretation of the economic data that we keep getting every single day and week. Now, this is an example of a trade that I took today. I bought an S&P 500 October 17th vertical call spread and at $0.97. And I took profits at 1.4. It ran slightly past that, but we got in really pretty much near the bottom and got out really near the top. Now, obviously, not all of our members trade spreads. Some like to trade naked options. Some like to trade complex strategies. Some simply just trade the equities directly through the SPY and triple Qs, ETFs, as well as other leveraged ETFs. We also have FX traders, futures traders. It's a really beautiful community of traders and investors that's made up of all kinds of amazing, awesome legends. It's less than $20 a month if you go for the annual membership, and you get access to all of this cool stuff, including all of my real-time analysis and trades, every single exit and entry. And that's the best way to support me if you want to do that. I want to show you some of the trades that our members took today. One member got 30% out of the trade. Another member made 100%. Another member also made 100%. So it really depends on how aggressive you want to be with your position or how conservative you want to be with your position. You can trade it any way you like it, as long as you know your risk and you manage it properly. Now, so what prompted us to take this trade today? It was this, everybody. The HYG, the smart money, is up top, the high yield bonds, and below is the S&P 500, the dumb money. And right off the bat, at the open of the day, I noticed that the S&P 500 closed below yesterday's close, making a new daily low. And the HYG actually opened up and rallied. So this is the first day of a new divergence building. And as you guys all know, this is one of my favorite entry and exit strategies, the smart and dumb money divergences. The last bullish divergence we had this beautiful run up, and then the prior divergence that we had was a bearish divergence that alerted us to this top in the S&P 500 in mid-August. We actually took a short position here. We wrote it down. We made 100%, nearly 100%. We took another short position here. We wrote it down, and then we made another near 100% trade. If you go back, you can see many other divergences that I track and I report. And this was another one, the June lows divergence, where the S&P made new lows and the HYG was making higher lows, leading to a bunch of nice rallies. There was another divergence right here that I did not mark up on the chart, but you get the picture. Again, guys, if you are interested in my daily real-time technical analysis and trades, please check out the link in the description to join our legendary trading community. Let's take a look at the dollar index, everybody, and the dollar index continues to inch its way up, but we do have some wind at our face. The PPO, the momentum is in bearish territory, and so we're inching our way up, but it looks to me like the dollar index wants to hammer out a short-term top where the S&P 500 finally puts a bottom, a tradable bottom, where we can trade to the upside on the S&P and to the downside on the dollar. Let's take a look at the 10-year yield. Same thing here, everybody. We're hammering out a double top on the 10-year yield. Now momentum is in bearish territory. We failed to make a bullish crossover, and so yields will likely now try to hammer out a bottom, cool down for a little bit, allowing the stock market to rally. Let's take a look at gold, everybody. I pointed out this bullish crossover on gold last week, alerting everybody, please do not short into the hole. As soon as we see this bullish crossover, the S&P usually rallies to the upside. That's exactly what happened. We're now retesting the September low, and we're likely hammering out another short-term bottom that can be traded to the upside. Leading into PPI tomorrow, the FOMC minutes at 2 p.m., and the CPI on Thursday. Let's take a look at another chart, everybody. Here, this is the gold divided by S&P 500, the gold ETF GLD divided by the S&P 500. And again, I am tracking and waiting for a bearish crossover on this ratio. This is a risk on, risk off ratio, everybody. As soon as we get a bearish crossover on this ratio, it indicates that money is exiting out of safe plays and into risk assets like the S&P 500. Look at this beautiful rally. Look at this beautiful rally. We're now waiting for another nice, beautiful rally. Let's take a look at the XLY divided by the XLP, consumer discretionary divided by consumer staples. Again, everybody, look at this. We had this pretty ugly, horrendous looking double top formation with a lower low on the, with a lower high on the PPO, indicating that this is indeed a double top formation. We had a neckline right here that I pointed out yesterday. We broke this neckline. We're now moving to the downside. We do have, let's see, 5% left in this move to the downside, where consumer discretionary is expected to underperform consumer staples by 5%, meaning XLP is expected to outperform the consumer discretionary sector XLY by 5% in this one last leg of selling. Let's take a look at the weekly chart, everybody. The weekly chart continues to look somewhat ugly, right? We have this shooting star candle that ran all the way to the upside and then reversed last week. We're now moving to the downside again. But remember, everybody, we do have a bullish divergence here on the PPO. We made a lower low here versus here and a higher low on the PPO. We're also seeing bullish divergences on the HYG. And let's take a look at our friend, the VIX. The VIX is now in very, very dangerous territory. This is the first time we have closed above this red line. This is Hell's Gate, everybody. I warned about this. We haven't closed above this red line in any of the sell-offs that we've seen year to date. This is the first time we've done that. And we've done it ahead of the CPI, ahead of the PPI. So you can only imagine what kinds of violent, volatile moves we are going to see in the next couple of days as those numbers come out. We could be really approaching now the final capitulation bottom that everybody's waiting for. We could simply be forming a bull flag here or a double top. We will not know for sure until we see the CPI. If you are a bull, you want to see the VIX cool down after the CPI and you want to see the market rally to the upside. We don't want to see the VIX shooting up and staying high after the CPI comes out, because that will only trigger more liquidations and sell-offs. And so we remain very cautious in the short term. In the next few days, everybody, we do have some bullish technicals, but we have to wait for the fundamentals, for PPI, CPI, and the FOMC minutes to confirm these bullish technicals. And that's why we took that quick trade and took profits early and booked that 40% profit today. Now, in the medium term, going into November and December, everybody, I am bullish Based on the seasonality, I expect a rally towards the beginning of November and another rally throughout December. And so I am beginning to position myself to take advantage of that rally with an edge that we found in the trading group that I shared today. I'm not going to talk about it in the video, but we found a really, really beautiful entry opportunity in one very specific name that we are going to take advantage of. And I'm hoping for 1,000% trade on this position. With that said, risk is still elevated for a second leg of selling towards the last week of October. Remember, we'll have a lot of earnings come out in the last week of October. So again, volatility will be revisited even if we rally off the CPI and PPI. Be careful. We are likely to see a second dip towards the back half of October right over here. I talked about both of these green and red faded lines in the last video. Please check that video out if you're interested in my forecast for the rest of the year. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.